Welcome to Reporting Matters, where we explore the world of corporate accounting. This episode is presented by Artificial Intelligence hosts and is for educational purposes only. For our full disclaimer, stay tuned until the end of the show. Let's dive in.
This is Reporting Matters. The Corporate Accounting Podcast starts now.
Imagine you run a company, a highly successful company, You haven't changed a single thing about your business.
Right.
Your sales are exactly the same. Your retail stores are operating as usual. Your employees are clocking in. And, well, your bank accounts hold the exact same amount of cash as they did yesterday.
Nothing has changed in the real world.
Exactly. Nothing. But overnight, your accountants switched the rule book they use to report your finances. And suddenly, to the outside world, you look like you are hundreds of millions of dollars in debt.
Yeah.
Your profit margins have completely changed, and you appear to be like on the verge of a liquidity crisis.
Yeah, I mean, it sounds like a magic trick, right? Or maybe even financial fraud.
Totally.
But it's neither. It is simply the reality of global corporate accounting. It's the reality that the numbers on a balance sheet are, well, they just aren't an objective truth.
That is the wild premise we are jumping into today. Welcome to the deep dive. We are talking about the fact that math, which we all assume is this universal, cold, hard, objective language, becomes incredibly bendy the moment it enters the corporate boardroom.
Very bendy.
We are looking at two major financial reporting frameworks today. On one side, we have IFRS, which is the International Financial Reporting Standards. That's the heavy hitter used by massive global corporations. And on the other side, we have Dutch GAAP, the generally accepted accounting principles used in the Netherlands.
And if you are listening to this thinking, I really do not care about the regulatory differences between accounting boards, I really challenge you to stick around.
Yeah, please do.
Because this isn't just about bookkeeping. It is about the fundamental DNA of how a business communicates its health to the world. I mean, it literally dictates whether a bank gives a company a loan to build a new factory or whether an investor decides to short their stock.
Right. So our mission today is to decode this language. We want to understand the underlying philosophies, like the actual beliefs about human behavior, risk, and value that drive these two systems. By the end of this deep dive, you're going to understand how two completely different realities can be extracted from the exact same set of business operations.
It's fascinating when you break it down.
It really is. And to make this tangible, I want to use a running hypothetical example today. Let's imagine a really high-end, successful Dutch bicycle manufacturer. We'll call them Vanguard Velo.
I like it.
Yeah, they make beautiful 5,000 euro carbon fiber bicycles.
That is a perfect anchor because Vanguard Velo is going to have to navigate some incredibly complex financial decisions, and the way they report those decisions will look radically different depending on whether they speak the language of IFRS or the language of Dutch GAAP.
Okay, so before we throw Vanguard Velo into the deep end of, corporate acquisitions and massive lease agreements, we need to understand the baseline. What are these two accounting frameworks actually trying to do? Because at their core, they aren't trying to deceive anyone, right? They share a very specific, almost philosophical goal.
They do. Whether you're looking at IFRS or Dutch GAAP, which, by the way, is a combination of Title IX of Book 2 of the Dutch Civil Code and the Dutch Accounting Standards, they are both what we call principle-based frameworks.
Principle-based, okay.
Right, and they both strive for the exact same holy grail, which is presenting a true and fair view of a company's financial position.
A true and fair view. I mean, it sounds very noble, like an oath in a courtroom. Tell the truth, the whole truth, and nothing but the truth. But principle-based is a very specific term. How does that actually work in practice?
Well, the best way to understand a principle-based framework is to compare it to a rules-based framework, like US GAAP, for example.
Okay, how's that different?
In a rules-based system, the accountants are handed a massive multi-thousand-page encyclopedia. It gives a granular, specific rule for almost every conceivable transaction. So if your company does X, you must record it using Rule Y. It's highly prescriptive.
It's like building a complicated Lego set with the instruction manual open on the table. You don't have to think about the structural integrity of the Lego castle. You just, you snap the blue piece onto the red piece because page 42 tells you to.
That's a really good way to look at it. You follow the steps and you are compliant. But IFRS and Dutch GAAP operate differently. They outline broad concepts, like overarching tenets of how financial reality should be captured, and then they require the company's management and their auditors to apply professional judgment.
So it's subjective.
Right. They have to align their specific, messy, real-world transactions with those broad principles.
So instead of a Lego instruction manual, they're basically handed a giant bucket of assorted bricks and told, build something that accurately represents a castle and make sure it doesn't collapse when the wind blows. They have to actually use their brain.
They have to use their professional judgment. And in the Netherlands, this concept is taken so seriously that it's enshrined in Dutch law. It's called the inzichtvereiste.
Inzichtvereiste. Okay, break that down for me.
It translates roughly to the insight requirement. It basically mandates that financial statements must provide sufficient insight for a user, like a bank or an investor, to form a well-founded opinion about the financial position and the results of the company. It's a mandate for economic reality over mere bureaucratic compliance.
Give me an example of how that overrides a rule. Like, how does that play out?
Let's say there is a specific accounting guideline on how to value a certain type of inventory. But following that specific guideline in your unique circumstance would actually make your company look healthier than it really is.
Oh, I see.
The inzichtvereiste legally demands that you deviate from the guideline. You must break the standard rule, use a different method that reflects the ugly truth, and then write a detailed note explaining exactly why you deviated, all in the service of providing that true and fair view.
That is fascinating. It actively punishes malicious compliance. You can't just throw your hands up and say, well, I followed the rules on page 42. It's not my fault the company looks profitable when it's actually bleeding cash.
Are on the hook for the insight. Now, because both IFRS and Dutch GAAP are aiming for the same true and fair view, they aren't completely alien to each other.
Right.
Over the past couple of decades, the Dutch Accounting Standards Board recognized that having completely divergent systems in a highly globalized European economy was just a nightmare. So they actively worked to align their local standards with IFRS where it made sense.
I picture it like two artists painting a portrait of Vanguard Velo, our bicycle company. They are both looking at the same subject. They both want to paint a hyper-realistic portrait. And over the years, they've started sharing some of their basic techniques. So the way they paint the tires or the way they sketch out the basic warehouse inventory, it looks very similar.
The structural foundation is highly comparable, yes. And this convergence is incredibly useful for Dutch businesses because of a unique piece of flexibility built into the Dutch system.
Okay, what kind of flexibility?
Well, if you run a massive publicly listed company on a European stock exchange, you have no choice. European law mandates that you must use full IFRS. But Vanguard Velo is a private, mid-sized company. They aren't on the stock market.
So they can just stick to Dutch GAAP.
They can, but Dutch legislation explicitly allows them to voluntarily adopt full IFRS if they want to. Or, even more interestingly, they can create a hybrid.
Hybrid?
Yeah. They can apply the complex measurement principles of IFRS, but present them using the simpler, scaled-down formatting and disclosure structure of Dutch GAAP.
Wait, why would Vanguard Velo ever volunteer for that? If I'm the CFO of a mid-sized bike company, dealing with one set of accounting regulations gives me enough of a headache. Why on earth would I willingly adopt a heavier, more complex international framework?
Because accounting is a strategic tool.
Yeah.
Let's say Vanguard Velo is doing incredibly well. They want to expand globally. To do that, they need to raise 50 million euros.
Okay.
Their local Dutch bank might not have the appetite for that kind of risk, so Vanguard Velo decides to seek venture capital from institutional investors in London or New York.
Ah, and those investors don't speak Dutch GAAP.
They don't. IFRS is the lingua franca of global capital. If Vanguard Velo hands a London hedge fund a set of Dutch GAAP financials, that fund has to hire analysts to spend weeks translating those numbers into a framework they understand before they can even begin to evaluate the risk.
That's a huge bottleneck.
It creates massive friction. By voluntarily adopting IFRS early, Vanguard Velo is signaling to the global market, we are sophisticated, we are ready for you, we speak your language. It removes a barrier to entry for foreign capital.
Okay, so the foundation is built on this shared pursuit of a true and fair view, with a lot of pragmatic flexibility. But as we hinted at in the beginning, once a company starts making big moves, the shared techniques disappear. The two artists grab completely different brushes, and the portraits of the company begin to diverge wildly.
Oh, absolutely. Let's put Vanguard Velo to the test. Let's see what happens when they decide to grow, not by selling more bikes, but by buying another company entirely.
This is a perfect scenario. Let's say Vanguard Velo realizes that the future of cycling isn't just about carbon fiber, it's about data. People want smart bikes, right?
Right, highly connected.
So they look across the market and they see a brilliant tech startup called Aerometrics. Aerometrics has developed an incredible AI fitness app that tracks biometric data, optimizes pedal strokes, and has a massive, fiercely loyal user base of 1 million cyclists.
A classic strategic acquisition.
Right. So Vanguard Velo approaches the founders of Aerometrics and says, we want to buy you. Now, if we look at Aerometrics' balance sheet, they're actual physical assets, like their laptops, their office furniture, maybe a few servers. They're worth, let's say, 10 million euros.
Okay.
But Vanguard Velo isn't just buying laptops. They are buying the brilliant engineers, the proprietary algorithm, and most importantly, that loyal user base of 1 million cyclists. So Vanguard Velo doesn't pay 10 million. They pay 50 million euros to acquire Aerometrics.
Wow, so they paid a 40 million euro premium over the fair value of the tangible assets. And in the accounting world, that 40 million euro premium has a very specific name. It is called goodwill.
Goodwill. It's the quantified financial value of a company's good name, its reputation, and its future earning potential. It's the magic dust that makes a company worth more than the sum of its physical parts.
Magic dust is exactly what it is. And how you account for that 40 million euros of magic dust after the acquisition is complete is one of the most violent philosophical clashes between IFRS and Dutch GAAP.
Walk me through it. Let's say Vanguard Velo's CFO is using Dutch GAAP. They've just wired 50 million euros, they own Aerometrics, and they have 40 million in goodwill sitting on their balance sheet as an asset. What does Dutch GAAP demand they do with it?
Dutch GAAP looks at that 40 million euros and applies a philosophy of deep conservatism. The core belief here is that no competitive advantage lasts forever.
Okay.
Aerometrics might be the hottest app today, but in the tech world, someone might invent a better app tomorrow. The brilliant engineers might quit. The user base might get bored. Dutch GAAP says, we do not believe your hype is permanent. Therefore, standard RJ 216 requires that goodwill must be systematically amortized.
Amortized, meaning they have to slowly destroy that asset on paper.
They have to expense it over its expected economic useful life. Let's say the CFO argues that the Aerometrics brand will give them a competitive edge for 10 years. Dutch GAAP forces them to take that 40 million, divide it by 10, and record a 4 million euro expense on their profit and loss statement every single year for a decade.
Okay, let me play devil's advocate here. Because if I'm the CEO of Vanguard Velo, I am furious. I just bought an incredible, growing tech company. It's wildly successful. The app is getting more popular, not less. And you were telling me that Dutch GAAP forces me to pretend, mathematically, that the value of this brand is slowly decaying and vanishing, chipping away my reported profits by 4 million euros a year, even if it's currently making me millions. That feels like lying in the opposite direction. It feels artificially pessimistic.
It is pessimistic, but from the perspective of Dutch GAAP, it is prudent. Think of it like buying a brand new delivery truck. The moment you drive it off the lot, you know it's going to suffer wear and tear. You know it will eventually break down and become scrap metal.
Yeah.
So you'd appreciate it over time. Dutch GAAP treats the intangible goodwill of a business acquisition exactly the same way.
Yeah.
It enforces a cleanup of the balance sheet. It ensures the massive premium you paid doesn't sit there inflating your assets forever. It matches the cost of the acquisition against the revenues it supposedly generates over a realistic time frame.
I see. It prevents a company from carrying a ghost asset for decades. You know, look how valuable we are. Remember that app we bought in 2026.
Exactly. Now let's contrast that with IFRS. Under IFRS 3, which handles business combinations, they outright prohibit the systematic amortization of goodwill. You cannot just divide it by 10 and write it down.
Wait, so under IFRS, that 40 million euros in goodwill just sits on Vanguard Velo's balance sheet forever.
Not forever, but it sits there untouched until it is proven to be impaired. IFRS takes a dynamic, market-driven approach. They basically agree with your CEO. They say, why should we artificially suppress your profits by 4 million a year if the Aerometrics brand is actually growing in value? That doesn't reflect economic reality. So instead of predictable amortization, IFRS mandates an annual impairment test.
An impairment test. How does that actually work? Because you can't just put an algorithm on a scale and weigh it.
No, you can't. It is an incredibly complex, highly subjective financial exercise. Every single year, the CFO of Vanguard Velo has to sit down and ask, is the Aerometrics division still truly worth the premium we paid?
And how do they prove that?
To answer that, they have to build complex discounted cash flow models. They have to project the revenue of the app for the next 5 to 10 years. They have to guess how many users will subscribe, what the churn rate will be, what the future inflation rate will be.
So they're essentially trying to predict the macroeconomic future of the fitness tech industry.
Yes. And then they have to apply what's called a discount rate, often the weighted average cost of capital, to bring those imaginary future cash flows back to a present-day value. If that complex, subjective math equation says the app is still worth at least $50 million, then the $40 million in goodwill stays on the balance sheet, untouched.
But what if a competitor releases a free app and Aerometrics' user base drops by half?
Then the impairment test fails. The math shows the value has dropped, and IFRS forces Vanguard Velo to take an impairment charge. They might have to write down 20 million euros of that goodwill in a single day.
Wow. A 20 million euro hit to their profit in one quarter.
Yes. We see this constantly in the financial news. A massive telecom giant buys a streaming service. They hold the goodwill on their books for 4 years, looking incredibly profitable because they aren't amortizing it. And then suddenly, market conditions shift, and they announce a $5 billion impairment charge. It shocks the market, their stock price tanks, and investors are furious.
I have a massive problem with the IFRS approach here. You said the CFO has to build models projecting user growth, estimating future cash flows, picking a discount rate. That sounds like a lot of highly educated guessing.
It is.
And who is doing the guessing? The very management team that pushed for the acquisition in the first place. If I'm the CEO of Vanguard Velo, I staked my reputation on buying Aerometrics. I am heavily incentivized to tweak the assumptions in that discounted cash flow model. Maybe assume a slightly higher growth rate or a slightly lower discount rate, just to ensure the math says the goodwill is still fine, so I don't have to report a massive, embarrassing loss to my shareholders.
You have just articulated the single biggest criticism of the IFRS impairment model. It relies heavily on management's subjective assumptions about the future, which introduces an immense risk of optimism bias, whether conscious or unconscious.
Yeah, human nature.
Exactly. This is why the impairment test requires armies of independent valuation experts and intense scrutiny from external auditors to verify that the assumptions aren't just fantasy.
The administrative burden must be staggering.
It is monumental. Doing a proper impairment test under IFRS costs a fortune in consulting fees, audit fees, and sheer executive time every single year. Compare that to Dutch GAAP. You paid $40 million, you divide by 10, you record a $4 million expense. It takes an accountant 5 seconds on a calculator.
So again, we see this divergence. IFRS aims for a hyper-accurate, dynamic snapshot of the current economic reality, even if it requires subjective guesswork and massive administrative costs. Dutch GAAP favors a cheaper, prudent, mechanical march toward zero, ensuring no nasty surprises for the creditors.
That is the perfect summary of the goodwill battle. And just as a quick historical footnote, there's a third way that used to exist, and technically still exists as a rare exception under Dutch GAAP, called the pooling of interests.
Pooling of interest, what does that mean?
Imagine Vanguard Velo doesn't buy Aerometrics for cash, but rather they execute a perfect merger of equals. 2 companies of the exact same size decide to join forces through a stock swap. It's hard to say who is the buyer and who is the seller. Under the pooling of interests method, you don't calculate goodwill at all. You literally just staple their historical balance sheets together.
So the assets just combine at their old historical costs. No premium, no magic dust.
Exactly. It's as if they were always one company. IFRS completely banned this method because it obscures the true economic cost of a transaction. If you merge, someone is usually paying a premium, and IFRS demands that premium be recorded and tested. But Dutch GAAP, in its pragmatism, retains it for very specific, narrow legal mergers where determining a clear acquirer is genuinely impossible. It avoids the artificial creation of goodwill entirely.
It's fascinating how a seemingly dry debate over amortization versus impairment completely changes the narrative of a CEO's legacy. Under IFRS, the CEO looks like a genius for years, reporting high profits until the day the music stops and they take a massive impairment hit. Under Dutch GAAP, the CEO takes a steady, predictable penalty every year for the acquisition, depressing their profits, but slowly building a bulletproof balance sheet.
It changes the way executives are incentivized to behave. But if you think the debate over intangible magic dust like goodwill is intense, wait until we look at physical assets. Let's look at what happens when Vanguard Velo decides they need physical space to sell their new AI-powered bikes.
Oh, this brings us to the great lease debate, the illusion of ownership. Because Vanguard Velo isn't just going to sell these high-end bikes online. They want flagship retail experiences. They want a massive, beautifully designed store in the heart of London, another in Tokyo, and another in New York.
And real estate in those locations is astronomically expensive. Vanguard Velo is a bike manufacturer. They don't want to tie up hundreds of millions of euros buying commercial real estate, so they do what almost every major retailer does, which is they lease the space.
Okay, let's run the numbers. They sign non-cancelable 10-year leases for 50 flagship locations around the world. Let's say the rent for each location is 1 million euros a year.
Right.
That means Vanguard Velo has just legally committed to paying 50 million euros a year for 10 years. That is a €500 million financial commitment.
It is a colossal liability, and how that €500 million commitment appears to the outside world is where IFRS and Dutch GAAP completely part ways. Let's look at the Dutch GAAP reality first. Under Standard RJ 292, the Dutch framework retains a historical distinction between two types of leases: financial leases and operating leases.
So what's the difference?
Financial lease is when you rent something for basically its entire useful life, and you get all the risks and rewards of ownership. If Vanguard Velo leased a factory robot for 15 years and it breaks down and they have to fix it, that's a financial lease. Dutch GAAP says you have to put that robot on your balance sheet as an asset and the future payments as a debt. It functions like a loan.
Makes sense. But what about the retail stores?
The retail stores are classified as operating leases. You are just renting space for a period of time. You don't own the building. The landlord fixes the roof if it leaks. And here's the kicker. Under Dutch GAAP, operating leases are kept completely off the balance sheet.
Wait, a €500 million legal commitment is it's invisible.
Invisible on the primary financial statements. You don't see the right to use the store as an asset, and you don't see the 10 years of rent payments as a liability. The only place it shows up is as a cash expense on the income statement each month when they pay the rent. And as a text disclosure, just a footnote buried in the back of the annual report saying, by the way, we have significant future lease commitments.
They are ghosts. You look at Vanguard Velo's balance sheet under Dutch GAAP, and their total debt looks incredibly low. They look agile, unburdened, and highly solvent. But what happens if they adopt IFRS?
If they adopt IFRS 16, the lights come on and the ghosts become very, very real. IFRS 16 uses what is called a single lessee model. They essentially abolish the concept of the operating lease for anything significant. IFRS looks at that 10-year retail contract and says, you have secured the exclusive right to use that property for a decade. That right of use is an asset. And you have a legal, non-cancelable obligation to pay €500 million for it. That is a liability. You must put both on the balance sheet.
So overnight, simply by changing the accounting standard, Vanguard Velo's reported assets increase massively, but their reported debt explodes by €500 million.
Exactly. It causes a phenomenon known as balance sheet inflation. When IFRS 16 was first implemented globally a few years ago, it literally added trillions of dollars of debt to the balance sheets of global airlines, shipping companies, and retail chains overnight.
That's insane.
Nothing about their actual operations changed. The planes were still flying, the stores were still open, but the optics of their leverage completely transformed.
Walk me through the mechanics of that, because they don't just write $500 million on the debt line, do they? There's a time value of money involved, right?
You're exactly right, and this is where the how gets really interesting. You can't just sum up 10 years of future rent payments because €1 million paid 10 years from now is not worth €1 million today. Inflation eats away at it, and there's an opportunity cost. If I had that money today, I could invest it and earn interest.
So how does the accountant calculate the actual liability for the balance sheet?
They have to use present value math. The CFO of Vanguard Velo looks at the $50 million a year they owe for the next 10 years. Then they have to determine an incremental borrowing rate. This is basically asking, if Vanguard Velo went to a bank today and asked for a loan to buy these properties over 10 years, what interest rate would the bank charge us?
Okay, let's say the bank would charge them 5% interest.
Okay, so the CFO takes that 5% rate and uses it to discount those future rent payments back to today's value. The rent due in year 1 isn't discounted much, but the $50 million due in year 10 is heavily discounted because it's so far in the future. When they run that complex present value calculation, that $500 million in raw future payments might translate to a present-day lease liability of, say, €380 million on the balance sheet.
It's still a massive number, and they have to do this complex discounting math for every single lease across multiple countries, potentially with different interest rates.
Yes. For a global company, implementing IFRS 16 requires incredibly sophisticated software systems just to track and calculate the changing present values of thousands of leases every month as time passes and interest rates shift.
Let's tie this back to the real-world consequences for Vanguard Velo. Why does this optical illusion matter if the actual cash leaving the bank account is the exact same?
It matters because of how the world judges risk. Let's say Vanguard Velo decides they need to borrow another 100 million euros to build a massive new carbon fiber weaving facility. They go to a major commercial bank. The bank's risk department runs Vanguard Velo's financials through their automated algorithms. One of the most critical metrics they look at is the debt-to-equity ratio. It measures how heavily the company relies on borrowed money versus shareholder money.
If Vanguard Velo is using Dutch GAAP, those 50 retail leases are off-balance sheet operating leases. Their debt looks low. Their debt-to-equity ratio is fantastic. The algorithm spits out a green light and they get a low interest rate on the factory loan.
But if they are using IFRS, that 380 million euro lease liability is sitting squarely in the debt column. Their total debt is massively inflated. The debt-to-equity ratio looks terrible. The algorithm flags them as highly leveraged and risky. The bank might deny the factory loan entirely or charge them a punitively high interest rate.
Just because of the accounting framework, the risk is exactly the same, the contracts are exactly the same.
It proves that the accounting framework can dictate business strategy. Before IFRS 16, companies were obsessed with structuring their contracts very carefully to ensure they qualified as operating leases, specifically to keep the debt hidden. It was a massive game of accounting gymnastics. A company might desperately want to buy a building because it made long-term economic sense, but the CFO would demand they lease it just to protect the balance sheet optics.
The tail wagging the dog.
Precisely. IFRS 16 was designed to stop that game. The IFRS board said, "We don't care how you structure the contract. If you have a non-cancelable commitment to pay for an asset, you have debt. Stop hiding it in the footnotes. Put it on the balance sheet where investors can see the true leverage of the company."
So again, IFRS forces radical transparency, exposing the true leverage of the company, but it inflicts a massive administrative nightmare and destroys carefully managed debt ratios. Dutch GAAP allows mid-sized companies to keep those operating leases as ghosts, shielding them from balance sheet inflation and making it easier to secure traditional bank financing. It's a huge competitive advantage for a local business.
It really is. Now, we've talked about how these frameworks treat the massive liabilities a company takes on. But what happens when we look at the other side of the ledger? How do they measure the value of the things Vanguard Velo actually owns and the money they earn from selling those smart bikes?
This leads us into an epic battle of ideologies regarding value and revenue, the clash between fair value and historical cost. If you want to start a fistfight at an accounting convention, I assume you just yell one of those terms.
You're not far off. It is the defining ideological fault line in modern financial reporting.
Let's lay out the differences. IFRS permits a very broad application of fair value. For many types of financial instruments, they actually require it. Dutch GAAP, on the other hand, strongly leans toward historical cost. They heavily restrict the use of fair value to very specific, limited assets.
Let's use Vanguard Velo to illustrate this. Let's say decades ago, before they were a massive success, the founders bought a small, historic brick warehouse in the center of Amsterdam to build their first prototypes. They bought it in 1990 for the equivalent of 1 million euros. Today, Amsterdam real estate has exploded. That warehouse is sitting on prime, highly coveted land. If they sold it today, it would easily fetch 20 million euros.
Okay, if I am the CFO, I want to use fair value. I want to tell the world, look at our incredible balance sheet. We have a 20 million euro asset. But you're telling me that under the standard historical cost model of Dutch GAAP, I have to leave that warehouse on my balance sheet at 1 million euros.
Actually, it's worse.
Wait, really?
Yeah, under historical costs, you've been depreciating that warehouse for 30 years. It might only be on your books for 200,000 euros.
That seems absurd. It is objectively, demonstrably false. The building is worth 20 million. Why would an accounting framework intentionally understate the value of a company so drastically? Isn't historical cost just a polite way of lying about what a company is actually worth today?
It sounds absurd until you look at the alternative, and this is where Dutch GAAP makes a very compelling stand. Let's say Vanguard Velo uses fair value. They mark the warehouse up to 20 million on the balance sheet. Fantastic, the company looks rich. But what happens next year? Let's say interest rates spike, the European economy enters a recession, and the Amsterdam commercial real estate market crashes. Suddenly, the warehouse is only worth 12 million.
Under fair value, they would have to write the asset down.
Yes, they would have to record an 8 million euro loss on their income statement. Now ask yourself, did Vanguard Velo suddenly become terrible at making bicycles? Did their core business fail?
No, they're still selling the same number of bikes at the same profit margin.
Exactly. But because of fair value accounting, their financial statements look like a disaster. Fair value introduces wild, unpredictable volatility into the financial reports. A company can report a massive profit one year and a massive loss the next, entirely driven by abstract market fluctuations that have nothing to do with their core business operations.
So the profit and loss statement becomes polluted by market noise.
Heavily polluted. Dutch GAAP defends historical cost because it provides absolute stability, reliability, and verifiability. If I ask an auditor to verify the historical cost of that warehouse, they just go to the filing cabinet, pull out the original deed from 1990 and say, yep, they paid $1 million. It is an undeniable fact. But if I ask an auditor to verify a 20 million euro fair value, they are relying on real estate appraisals, market sentiment, and estimates. Historical cost grounds the financial statements in actual realized cash-backed transactions rather than theoretical market sentiment.
It's the difference between opening your wallet and counting the physical euros you have versus checking an app that tells you how much money you might make if you manage to sell your vintage watch collection at an auction this afternoon. One is a fact, the other is a fluctuating hypothesis.
That is a brilliant way to conceptualize it. IFRS wants the auction estimate because investors want to know the current market capitalization potential. Dutch GAAP wants to see the receipt because creditors want to know the grounded reality.
I will say, the source material does mention that even Dutch GAAP allows fair value for certain things, like investment properties. Why the exception?
That goes back to the IFRS, the insight requirement. If Vanguard Velo wasn't a bike manufacturer, but was actually a real estate investment trust whose entire business model was buying, holding, and trading properties, then historical cost is genuinely useless to a reader. If your business is market volatility, you have to report market volatility. But for a bike manufacturer that just happens to own a warehouse, the fluctuating market value of the bricks doesn't give you any insight into how good they are at building bikes.
That makes perfect sense.
Yeah.
The accounting method changes based on the core nature of the business. Okay, so that's how we value the physical assets. But what about the core operation itself, selling the bikes? This brings us to revenue recognition and impairments.
Revenue is the lifeblood of any company. And interestingly, this is one area where Dutch GAAP is actually conceding ground and converging with IFRS.
Right.
Because recognizing when you have actually earned money has become incredibly complicated. In the old days, Vanguard Velo sold a bike, the customer handed over cash, they recorded revenue. Simple. But now, remember our scenario, Vanguard Velo bought Aerometrics. They aren't just selling a piece of metal anymore.
Right. Let's say they sell a smart commuter bundle. For 4,000 euros, the customer gets a premium e-bike, a 3-year subscription to the Aerometrics AI coaching app, and a 2-year routine maintenance contract at any flagship store.
Exactly. The customer pays 4,000 euros on day one. How much of that 4,000 euros can Vanguard Velo record as revenue today? They can't record it all because they haven't provided the 3 years of app service or the 2 years of maintenance yet. They still owe the customer work.
Historically, how did Dutch GAAP handle that?
Dutch GAAP had localized, broad principles. It basically said, recognize revenue when the significant risks and rewards of ownership have transferred. But with complex software bundles, that guidance was too vague. Companies were interpreting it wildly differently, leading to inconsistent reporting. So the Dutch Accounting Standards Board decided to align their standard, RJ 270, with the international standard, IFRS 15.
IFRS 15 uses a strict 5-step model for revenue recognition. Walk me through how Vanguard Velo applies those 5 steps to the smart commuter bundle. Let's see the mechanism in action.
Okay, step 1, identify the contract. That's easy. The customer signed a purchase agreement for the bundle. Step 2, identify the performance obligations. What exactly did Vanguard Velo promise to deliver? In this case, there are 3 distinct obligations: the physical bike, the 3-year app subscription, and the 2-year maintenance contract.
Makes sense. They owe 3 different things.
Step 3, determine the transaction price. That's the 4,000 euros the customer paid. Now, step 4, this is the hardest part. Allocate the price to the performance obligations. The CFO has to figure out the standalone selling price of each component. If they sold the bike by itself, maybe it's 3,000. The app subscription alone might be 600. The maintenance alone might be 400. They have to mathematically allocate that total 4,000 across the 3 buckets based on those standalone values.
They slice the pie.
They slice the pie. And finally, step 5, recognize revenue when or as you satisfy each obligation. They deliver the physical bike to the customer today. Boom, they can instantly recognize the 3,000 euros allocated to the bike as revenue. But the 600 allocated to the app, they have to slowly drip that into revenue over 36 months as they provide the software service. The 400 for maintenance, dripped over 24 months.
That is a highly rigid, logical progression. It entirely removes the ambiguity. You can see why Dutch GAAP would adopt that. It stops companies from front-loading all their software subscription revenue on day one to make their current quarter look amazing.
Exactly. It's a very robust framework. But while Dutch GAAP is happy to borrow IFRS logic for revenue, they fiercely reject IFRS logic when it comes to the opposite side of the coin, recognizing losses, specifically impairments on financial instruments.
This leads us to IFRS 9 and the expected credit loss model.
To understand why this divergence is so aggressive, we have to travel back in time to the 2008 global financial crisis.
Let's do it. Context is everything.
Before 2008, almost all global accounting standards operated on an incurred loss model. Let's say a major bank issued a massive portfolio of mortgages. Under the incurred loss model, the bank was strictly forbidden from recording a loss on those mortgages until a specific trigger event happened, meaning they had to wait until the homeowner actually missed a payment or officially filed for bankruptcy before they could admit the loan was going bad and write it down.
Which explains a lot about 2008. The banks were holding billions of dollars of toxic subprime mortgages. Everyone knew the housing bubble was wobbling. But because the homeowners hadn't officially defaulted yet, the bank's balance sheets looked incredibly healthy, right up until the exact millisecond the entire global system imploded.
It was heavily criticized as too little, too late. The accounting rules forced banks to wear a blindfold. So in the aftermath, the IFRS board vowed to never let that happen again. They created IFRS 9 and the expected credit loss, or ECL, model. It completely flipped the script. It mandates that you must be forward-looking.
How forward-looking?
Aggressively so. Under IFRS 9, the very minute a bank issues a loan day one, when the ink is still wet and the borrower has perfect credit, the bank must immediately estimate the probability that the loan might default in the future. They have to record a provision for that expected loss on day one.
Wait. They just issued a perfectly good loan to a qualified buyer, and IFRS forces them to instantly record a mathematical penalty, assuming it might go bad.
Yes. They have to constantly model macroeconomic futures. Let's say Vanguard Velo starts offering in-house financing to customers buying fleets of bikes. They have millions in outstanding loans. Under IFRS 9, Vanguard Velo's accountants can't just look at whether the customers are paying on time today. They have to pull data on national unemployment projections, GDP growth forecasts, inflation metrics. They have to run statistical models. If unemployment rises by 2% next year, our model suggests 5% of our customers will default. They then have to calculate the total exposure and record that expected loss today.
That is wild. They have to essentially predict a macroeconomic recession before it happens and penalize their own balance sheet for it in advance.
Yes. It requires armies of quantitative analysts, data scientists, and incredibly complex statistical models calculating probability of default and loss given default. It is a monumental, subjective, predictive effort.
And what does Dutch GAAP say about this futuristic ECL model?
Standard Dutch GAAP politely declines. While they offer an option to adopt it if a company really wants to, the standard Dutch framework primarily sticks to the traditional, historical, incurred loss approach.
Why? Didn't 2008 prove the incurred loss model was dangerous?
It's dangerous for massive, systemically critical global banks. But remember who Dutch GAAP is built for. Is it really useful to force Vanguard Velo, a mid-sized bike company that happens to offer some financing, to hire a team of macroeconomists to build predictive models about the Dutch GDP? No. It's an absurd administrative burden. Dutch GAAP says, stick to reality, don't record a loss until there is actual concrete evidence that the customer is in financial trouble. They prefer the reliability of the present over the speculative, highly modeled anxiety of the future.
Which brings us to the ultimate question. We keep seeing these same battle lines drawn. IFRS wants dynamic fair values, massive present value lease liabilities, and complex macroeconomic forecasting models. Dutch GAAP wants historical receipts, ghost operating leases, predictable goodwill amortization, and evidence-based losses.
Why do they have these completely different priorities? Who are they actually building these rules for?
This is the crescendo of the entire debate. This is the moment where the frameworks reveal their true loyalties. If you understand this, you understand everything we've talked about today. Let's look at how they handle legal reserves.
Legal reserves. It sounds incredibly dry, but the implications here are explosive. Let's go back to Vanguard Velo's historic Amsterdam warehouse.
We established that under Dutch GAAP, they generally use historical cost. It stays on the books at its low original purchase price. But we also noted there was a rare exception where they could choose to revalue it to its fair value of 20 million euros.
Yes, if they justified it under the insight requirement.
Okay, let's play that out. Vanguard Velo revalues the warehouse. On paper, their assets just jumped by roughly 19 million euros. Because assets must equal liabilities plus equity, their company equity, the wealth belonging to the shareholders, also just artificially inflated by 19 million euros. The CEO looks at the balance sheet and says, "We are rich. We have all this new equity. Let's declare a massive cash dividend and pay ourselves out of this newfound wealth to celebrate."
And this is where Dutch GAAP, backed by the full force of Dutch corporate law, slams the door shut and locks it. Under Dutch rules, when you revalue an asset upward to fair value, you cannot just dump that gain into general equity. You are legally required to create what is called a non-distributable revaluation reserve.
Non-distributable, meaning the CEO is legally barred from paying it out as a dividend.
Exactly. The Dutch law forces the company to take that 19 million euro paper profit and lock it in a vault on the balance sheet. It is trapped equity. You cannot touch it.
But wait, under IFRS, do they have these locked reserves?
No. IFRS has absolutely no capital preservation rules like this. IFRS believes its only job is to measure the numbers and require the company to disclose any dividend restrictions in the footnotes. IFRS does not tell a company what it can or cannot do with its own equity.
Okay, let's unpack why Dutch law locks the vault, because this is the aha moment. What happens if Vanguard Velo, operating under IFRS without these strict legal reserves, decides to go to the bank, take out a 15 million euro cash loan against their new, shiny 20 million euro warehouse, and then uses that borrowed cash to pay the shareholders a massive dividend?
The shareholders get incredibly rich today. They take the cash and buy yachts.
But what happens tomorrow if the real estate market crashes, the warehouse drops in value to 10 million, and bike sales slump?
The company can't pay back the 15 million euro loan. They go bankrupt.
And who gets hurt? The shareholders are fine. They already took the cash out.
Exactly. The people left holding the bag are the creditors. The local bank that lent them the money, the suppliers who shipped them carbon fiber frames on credit, the employees whose pensions are tied up. The company has been hollowed out. All the value was extracted by the owners based on a fleeting paper profit, leaving an empty shell to collapse on the local economy.
And that is what Dutch GAAP is designed to prevent.
Precisely. This is the core philosophical split. IFRS is an accounting framework designed entirely by and for global investors, capital markets, equity shareholders, the people buying and selling stock. Investors want dynamic fair values and predictive models so they can judge market capitalization and buy or sell shares at a profit.
But Dutch GAAP is fundamentally rooted in continental European corporate law, which historically prioritizes the protection of creditors.
Yes. The banks, the suppliers, the local stakeholders, the statutory legal reserves required by Dutch law act as a financial moat. By forcing Vanguard Velo to lock up that 19 million paper profit, Dutch law ensures that cash stays trapped inside the business as a buffer. If the market crashes, that buffer absorbs the blow, ensuring the company still has assets to pay the local bank and the suppliers. It prevents the malicious extraction of unrealized wealth.
And it's not just revalued real estate, right?
Okay.
His sources mention other legal reserves.
Yes. Dutch law mandates locked reserves for capitalized research and development. Let's say Vanguard Velo spends $5 million developing a revolutionary new gear-shifting mechanism. They capitalize it, meaning they put it on the balance sheet as an asset instead of expensing it immediately. Their equity goes up. But Dutch law says you can't pay a dividend out of that. You can't pay your electric bill with an unfinished patent. It's not liquid cash. So that equity is locked in an R&D reserve.
Same with foreign profits, right?
Exactly. If Vanguard Velo's subsidiary in Japan makes €1 million in profit, but due to currency controls or strategic reasons, they haven't actually wired that cash back to the parent company in Amsterdam, Dutch GAAP forces them to lock that equity in an undistributed foreign profits reserve. You cannot pay a dividend in Amsterdam based on cash that is physically trapped in Tokyo.
It is an incredibly paternalistic, deeply conservative system designed to ensure that a company is actually as solid as it claims to be, not just wealthy on paper.
Which is exactly what a creditor lending you money wants to see. They want a bulletproof balance sheet. IFRS provides a high-definition, highly volatile live stream of a company's economic potential for stock traders. Dutch GAAP provides a conservative, anchored, heavily fortified fortress for lenders.
Which brings us to the final piece of the puzzle, the day-to-day reality of running a business under these two regimes. If IFRS is built for global hedge funds demanding massive data, and Dutch GAAP is built for local banks looking for a solid fortress, how does that affect the actual paperwork, the burden of proof?
It creates a canyon between the two frameworks regarding compliance costs. We are talking about the difference between a routine checkup and a forensic audit.
Let's look at the requirements. Under IFRS, the disclosure focus is described as highly demanding, requiring extensive note disclosures. I equate IFRS to going into a hospital for a grueling, multi-day, full-body MRI. They don't just want your weight and blood pressure. They want a map of your vascular system. They want to know what you ate for breakfast 3 weeks ago, and they want an actuary to build a statistical model predicting how that breakfast might affect your cholesterol in the year 2035. Every single assumption the CFO made, every discount rate used in the goodwill impairment test, every macroeconomic variable used in the expected credit loss model must be laid bare, justified, and debated in pages and pages of footnotes.
It is an immense undertaking. The annual report of a major multinational corporation using IFRS can easily run to 3, 4, or even 500 pages. The actual financial statements, the balance sheet, and income statement might only be 5 pages long. The remaining hundreds of pages are purely disclosures explaining the complex math and assumptions behind those 5 pages. Generating that document requires dedicated teams of specialist accountants, external valuation consultants, and corporate lawyers. The financial cost of simply producing the report is staggering.
Which perfectly explains why mandatory full EU IFRS is strictly reserved for listed companies. The massive public corporations that are tapping into billions of dollars of global capital. They can afford the MRI. They have the armies of accountants. The cost is justified by their access to the global stock market.
Right. But now, bring it back down to earth. Imagine you are not Vanguard Velo, the massive international bike brand. Imagine you are a local Dutch bakery chain. You have 20 employees, you make fantastic bread, you are highly profitable. You are not trying to raise 50 million in London. Your only stakeholders are the local Dutch bank that holds the mortgage on your ovens and the local tax authority.
Subjecting that bakery to the full-body IFRS MRI would be cruel and unusual punishment. The audit fees alone would wipe out their entire profit margin for the year. They would go bankrupt just trying to calculate the expected credit loss on a catering invoice.
Exactly. And that is the beauty and the genius of the Dutch GAAP system. It is explicitly scaled. It recognizes that the burden of proof should match the size of the entity and the needs of its stakeholders.
How does the scaling work?
Dutch corporate law categorizes companies into 4 buckets based on their size: micro, small, medium, and large. The categorization is based on strict thresholds regarding the value of their assets, their net turnover, and their number of employees.
So the bakery falls into the micro or small bucket.
Yes. And if you are in the small bucket, the amount of disclosure you have to provide under Dutch GAAP is drastically reduced. It's the equivalent of the local checkup. The bank steps on the scale, checks your blood pressure, and if everything looks normal, you're done. You don't have to write a 50-page essay justifying your assumptions about macroeconomic risks. You might not even have to publish a full cash flow statement. You just present the core historical numbers.
For a small or mid-sized business owner in the Netherlands, being allowed to use this scaled-down Dutch GAAP is a monumental relief. It saves immense amounts of administrative time, it slashes auditor fees, and most importantly, it allows the management team to focus their energy on actually running the business, baking the bread, building the bikes, rather than just feeding an insatiable reporting machine.
It is pragmatism at its finest. The Dutch framework adapts to the reality of the business rather than forcing the business to conform to a theoretical global ideal.
This has been an incredible journey. We started with the premise that math is objective, and we have utterly dismantled that idea. For everyone listening, we've taken a deep dive through the hidden mechanics of how a business translates its actions into a story. We've seen how two systems, IFRS and Dutch GAAP, both aiming for a true and fair view, take entirely different paths to get there.
We've seen the global language of IFRS. It gives us dynamic fair values, massive right-of-use lease liabilities inflating the balance sheet, complex forward-looking impairment models trying to predict the future, and exhaustive hundreds of pages of disclosures. It is a system built to capture the theoretical economic reality of the exact moment in time, volatility and all, designed entirely to feed the insatiable data needs of the global stock market investor.
And we've contrasted that with the fortified walls of Dutch GAAP, a system rooted deep in corporate law and creditor protection. It gives us the unshakable stability of historical cost. It forces the conservatism of amortizing goodwill, demanding that companies admit their advantages decay over time. It creates strict, locked-down legal reserves to ensure real capital stays trapped inside the business to protect the local banks and suppliers. And it favors a scaled, pragmatic approach to paperwork that lets smaller companies breathe.
It highlights the ultimate truth of our discussion. Accounting is not a passive recording of history. It is an active translation. It is a lens that heavily distorts or sharpens reality depending on who is looking through it.
Which leaves me with one final lingering question for you, the listener, to ponder as we wrap up. We've spent this entire time talking about how the accounting framework changes the perception of a company's financial health. It makes Vanguard Velo look heavily indebted with IFRS leases, or less profitable in the short term under Dutch GAAP due to goodwill amortization. We treat it as an optical illusion. But what if it goes deeper than perception?
That is the truly provocative thought. Does the accounting framework actually end up dictating the company's real-world behavior?
Think about it. If you are the CEO of a company, and you know that signing a 10-year lease for a new flagship store will absolutely blow up your debt-to-equity ratio under IFRS and ruin your chances of getting a bank loan, do you change your strategy? Do you decide to just buy a smaller building instead, draining your cash reserves even if leasing the big store was operationally the better choice for selling bikes? Or, if you know that acquiring an exciting tech startup will drag down your reported profit for 10 solid years under Dutch GAAP's forced amortization, do you decide to cancel the acquisition and try to build the tech yourself, slowing down your innovation?
Do business leaders end up making fundamentally different, sometimes suboptimal choices about what to buy, what to lease, and how to operate, simply to satisfy the arbitrary rules of the paper the results will be printed on? It is the ultimate case of the tail wagging the dog. When the measurement tool becomes the target, human behavior inevitably shifts to fit the tool.
It is something to chew on the next time you read a headline about a corporate merger, or a massive impairment charge, or a company boasting about its record profits. Thank you for joining us on this deep dive into the clash of the accounting titans. Remember, whether you are looking through the lens of IFRS or the fortified glass of Dutch GAAP, the numbers you see are never just numbers. They are a narrative. They are shaped by rules, philosophies, and the invisible hand of regulatory history. They are the story of the business itself, told in a very specific and highly debatable language. We'll catch you on the next deep dive.
Thank you for listening to Reporting Matters. Before we go, please note that this discussion is for informational and educational purposes only. Nothing stated in this episode constitutes investment, legal, financial, accounting, or tax advice, nor does it replace the professional judgment of a qualified human professional. Reporting Matters endeavors to ensure the quality of its content, but AI systems can generate inaccuracies. We make no warranties regarding the completeness, timeliness, or accuracy of this information. Listeners should conduct their own independent research and consult a certified financial professional before making any financial or investment decisions.